Looking at the Cisco stock around the year 2000 and Nvidia, we see today's AI boom looked a lot like the 1990s tech bubble. This is Nvidia stock price during the 2021 up to summer of 2025, while the red line is the Cisco stock during 1996 to 2001 when dot-com bubble peaked. Over the past few months, we kept hearing Nvidia will eventually end up like Cisco. It took Cisco approximately 5 years to grow like this and then fall. If we take a similar duration to grow for Nvidia, we notice a similarity. However, this idea did not prove correct. As right now in September 2025, Nvidia continues skyrocketing. Similar growth period for Nvidia clearly did not cause such a major fall. Cisco climbed up to around 1,700% and Nvidia up to 1,200% during similar timeframes. What we'd like to say is that we do not believe Nvidia is like Cisco and will not eventually fail like Cisco. Just so you know, during the dot-com era, Cisco's late 90s surge was fueled by venture capital-backed startups spending borrowed money on networking gear. However, venture capital firms are among the most riskiest ones in the economy. Many of them eventually failed, and the demand vanished. This is a highly different situation from Nvidia, whose demand comes from a few huge, profitable hyperscalers, which makes the revenue base much sturdier. The dot-com analogy is therefore weak in our view. Nvidia is obviously one of many tech firms focusing on AI, and while we don't think it's extremely overvalued, there is one particularly powerful indicator to pay attention to: the Dow Jones to M2 money supply ratio. To explain briefly, when this ratio climbs significantly, it means the stock market as a whole is inaccurately valued, essentially overheated. When the ratio is low, it signals that stocks are cheap. Unlike many economists, we believe the stock market can absolutely form bubbles. Right now, we see signs that such a bubble may be forming, since the Dow to M2 ratio is climbing. It's not yet at the extreme levels of the dot-com crisis, but it is still significantly elevated, which raises the risk of a major correction. Whenever M2 spikes too quickly, that excess liquidity influences the stock market. The reason we use the Dow to M2 comparison is that money supply is an extremely powerful force in the economy. When the Fed injects liquidity, it doesn't just mean consumers spend more. It also lifts corporate profits and encourages more investment, which naturally pushes valuations higher. Major rounds of quantitative easing are always reflected in stock market valuations. In our view, markets should actually track the M2 curve quite closely. As mentioned, the current rise in the ratio raises the question of whether the rally we've seen over the past months is truly sustainable, or whether it's becoming just another AI-driven bubble. And with rates expected to go down, the impact of liquidity on markets will only grow more important. The 1995 to 2004 period is a good reference. For long stretches, the S&P 500 and the Nasdaq 100 moved at a similar pace. Because the Nasdaq 100 is dominated by tech, it pulled ahead when tech was strong and then fell much harder when the cycle turned. From 2000 to 2002, the Nasdaq 100 dropped about 70%. That run and collapse contradict the strong version of the efficient market hypothesis, the idea that bubbles don't exist and prices are always correct. Valuations got far ahead of fundamentals and later corrected. From 2020 to 2025, we're seeing a similar pattern. The Nasdaq 100 often tracks the S&P 500, then outperforms on rallies and gives back more on drawdowns. Same composition story: tech-heavy index, bigger upside and bigger downside. Chart AI usage in big firms dropping heavily. Bad and logical news. If we look at how big firms' AI usage developed, we see it rose steadily through 2024 and accelerated into mid-2025 from roughly 5% in early 2024 and peaked around 14%, meaning 14% of big firms with more than 250 employees implemented AI to some degree of their processes. However, right now, we're noticing only about 12% of firms reported, meaning firms are not exactly using AI as much as they did months ago. That is exactly the bad and sharp news for the AI-focused stocks. The markets know this, as the human expertise remains at a premium. Companies still need people to direct and govern those actual AI systems to get value from it. If this curve will continue to drop, we'd likely see a hit to those AI tech firms and their stocks. This survey comes from the US Census Bureau, covering roughly 1.2 million firms, meaning large sample to allow us to get an authentic look of the economy.